We're running a bit late on time, and this is the final panel for the day. And I always love doing the last panel on a full day conference because now I get to see who's really real and who's just stopping by for the food. But we wanted to close with a bang, and when Mike accepted our invitation, or the former commissioner accepted our invitation, I was thrilled and dancing around our office. And I'm gonna let Mike introduce himself more thoroughly, but I'll just start out by saying he's the rare combination of somebody who knows fixed income markets, has extensive experience as a regulator, and is free to speak his mind and give his own opinion. So that's a rare, rare treat. I think a lot of times we do have regulators participate and we always appreciate that, but then there are always terms and conditions that they have to give before they express an opinion, and there's a bit of a Leonard Nimoy, Spock sort of atmosphere around their statements by design. But now you are unshackled, you are a free agent.
Unchained.
But before we get into the topics of this afternoon keynote, I'd love for you to give like a brief history of your origin story and the work that you've done in the regulatory space.
Sure. First of all, thank you, Chris, for inviting me here. The work you do in this space is fantastic, and I've always enjoyed the conversations with you and your colleagues at ViableMkts, both on the equity side, the bond, and the fixed income side, and now I understand Dave's getting into the crypto space, and so always enjoyed those conversations. As a regulator in Washington, D.C., I was a commissioner for 5 years at the SEC and was designated acting chairman for 3.5 months. I always liked when folks from outside of D.C. would come down and just talk about the markets, right? Because Washington, D.C. can be an echo chamber. Trade associations are great, lobbyists are great, but after a while you start to hear the same things over and over again. So hearing from folks who are actually out doing real things in the real markets. I see some familiar faces here. I see Jim Tabachi who's come down to see us. Chris Ferrari was here earlier. Dick Berner, of course, and a lot of other folks. And so it's great to be out with folks who are actually doing some real things. And so I noticed you have me as former acting chairman and commissioner. So that means I'm a has-been. So I guess better a has-been than a never was. So one of the things I actually prided myself on when I was a commissioner was I would have to give my disclaimer. And then I did try to actually speak my mind. So maybe I'm even more unchained than I normally am. So how did I become a commissioner? Well, I was an academic and I did research in equity market microstructure. So I was an equity markets guy. Back in the day, the late 90s, early 2000s, I was pounding on the trade and quotation database, the old TAC data, trying to come up with the next research project. And in order to get serious about my research, I decided to go to the Securities and Exchange Commission as a visiting academic. And the SEC has a long tradition of supporting academic research, evidence-based policy making. Think what you will about a lot of the SEC's policies and stuff, but we really try to be evidence-based. And as an acknowledgement of that, bring in academics with backgrounds to try to inform the policy making. And I thought I was going to spend my career there working on equity market microstructure. It was literally my second day there in the summer of 2002. Our chief economist at the time, Larry Harris, came to me and said, do you realize we have every transaction in municipal bonds for, I think it was a 2-year period? And I said, no. And he said, do you want to work on a project? And I said, sure. And he said, great, because if you said no, I would have fired you. And then I spent the next 2 years learning as much as I could about the fixed income markets. It turned out I walked into the agency not only when the SEC was working with the MSRB on what was then the RTRS system, now the EMA system, and adding regulatory transparency and public transparency to the municipal bond market. They were actually just beginning to work with then NASD, now FINRA, on what became the TRACE system and adding transparency to the corporate bond market. And that sort of veer in the road in terms of my career and spent as much time as I could learning about primary issuance, secondary market trading, market structure, all the institutional details related to the municipal bond and corporate bond markets. And so found it absolutely fascinating. So as someone who came from the equity world, I started calculating markups or spreads in the bond markets. And sort of two things jumped out at me that made me think that I actually had all my programs wrong. I was like pulling in literally hundreds and thousands, in some cases millions of transactions, was that the spreads in the fixed income markets were magnitudes higher than they were in the equity markets. And the second thing that I noticed was that if you plot transactions costs as a function of trade size, right, in the equity markets, you get retail trades, you get very tight spreads, you usually get the inside bid and ask. right? Institutional size trades, the bigger the trade, you got to work the order, there's implementation shortfall, you got to worry about blowing through the book, you got to do all this other sort of stuff, and transactions costs go up the larger the trade size. In the bond markets, it was the opposite. Retail was paying much higher spreads than institutional size trades. Now, for those of you that have been in this market for a long time, you're like, well, of course, and you kind of know that stuff. But if somebody come in and then it started asking questions, well, why is that the case? Is it due to the market structure? Is it due to transparency? Is it due to dealer market power? Is it due to a number of different things? And so that began our quest to look at what was the impact or what was the link between transparency and liquidity. And we had a lot of folks that were worried about adding public transparency to the bond markets and happened to be there when we added transparency to both the muni and corporate bond markets. So.
And that's one of the reasons why we were very excited to have you here, because I think one of the key market structure themes that everyone's anticipating for the U.S. Treasury market is, the story of bringing in post-trade transparency. And what I find amazing is we seem to be hearing a lot of the same pushback that was there probably when you were talking about moving Emma forward or moving Trace forward for munis and corporate bonds respectively. And the other thing that I find is that the pushback doesn't seem to be backed by any sort of scientific data. It's more just, I think that this is going to hurt the market and therefore it is the case. And so really happy to have you here because you were actually there, you saw the before, the during and the after. So what were the early days of putting in transparency in those other markets? And were the fears the same and were those fears realized?
Yeah, they were exactly the same, and they were not realized. It's a little bit like Back to the Future. I hear the same sort of arguments about adding transparency to the markets, right? So what happened was the SEC working with FINRA or what was then the NASD. The NASD put together what they call the BTRC, the Bond Transaction Reporting Committee, which they had outside folks, some of the major dealers and some of their folks. Was like, how are we going to add transparency to the market? And they sort of had this, if it ain't broke, don't fix it, or first do no harm to the markets. And so what they decided to do was phase in transparency to the market. So the idea was we're not going to do a big bang because then if the regulators or the economists or the academics were wrong, then we screwed up the market. So what they decided to do was phase in the corporate bond market, phase in transparency, and started with on the credit ratings, I think it was AA or A and above, and over a certain large issue size. I think it was like $1 billion.
You had to be over $1 billion, and they first started with AAAs, and then they started to move forward. I think the idea was, well, everybody knows where these names are anyway.
Right.
But what could you articulate what the fear was? Because I'm sure you got a few angry phone calls, maybe some doorbell pranks where you had to, stamp out a flaming bag on your porch.
Yeah.
What was the general theme? What were people afraid of? What was this thing that could harm the market by showing people where things had traded?
Yeah, it was somehow that if we put prices out there, that people were going to be less willing to trade, that dealers were going to be less willing to commit capital, and that was going to freeze up the markets, and sort of the world was going to end. And so when we went through the phase, they decided, all right, well, let's do sort of what are probably the most liquid to begin with anyway, and the least likely to have any harm. So that's why it started up. It was $1 billion in AAA, I think it was. And then sort of worked the way down. The problem with that research design was that when we did the first phase in, everything was fine, everything was positive. But then then the pushback was, well, yeah, we knew it for those bonds. It's that next set are going to be the ones that we're going to have the problem in. And we couldn't get around that. So that's why we ended up working with NASD and said, look, we got down to the triple Bs. They said, we can't do it for all the triple Bs because we're afraid it's going to ruin the market. So we asked them to go out, find some academics. They found 3 academics to design a randomized a trial for them, where they actually went out and picked, I think it was like 30 triple B bonds, and some were already fairly liquid, some were not so liquid, and so you get a stratified sample rather than do the entire population. And what these academics did was something clever. They not only sort of picked them to sort of represent the different sort of profiles of the bonds, they didn't tell anybody, but they also picked ones that had good matches for other bonds that had very similar, so they could do a very, very controlled experiment on that. And so what happened was there were 3 of us that did sort of rigorous academic studies that were published in the top 3 academic journals. This never happens, but we all sent them to the top 3 journals, to separate ones. They all got published. Our project that we worked on at the SEC was one where we looked at the different cohorts in trace, and we looked at what happened each time. And what we found was that it improved, that transactions costs went down, volume either went up or stayed the same. So the trade-off people kept talking about, one of the big fears was that, sure, spreads are going to narrow, but then volume's going to dry up.
The incentives will go from the marketplace.
Exactly, and the opposite happened, right? The NASD group, those academics had that very, very controlled sample for the triple B.
Right.
Then there was a third study where academics had gotten data for, I think it was insurance companies that had reported transaction data, and they actually were able to look at pre and post trace and look at what happened to those institutions. Now I mentioned, right, so institutions already had tight spreads anyway. What they found was just simply turning trace on, institutions even got better transactions costs immediately from trace. You got 3 things that show the exact same thing. To this day, I get people pushing back and say, oh, trace ruined the bond markets. Adding transparency to the bond markets was terrible. We can't let that happen in the treasury market. When I was on Capitol Hill, working in the Senate banking, we can't let that happen in the derivatives market. And I say, look, here are 3 papers that were written that show the exact opposite. I will send them to you. If you find anything wrong with any of these 3 papers with the research design, the results, let me know. And I never hear back from anyone.
Well, I believe you, because what we're seeing, I mean, the first idea that came out of the Fixed Income Market Structure Advisory Committee, which was, pulling professionals from the market and having them come up with a recommendation for what should happen around transparency. Their first idea was, if you delay the reporting of block trades in the U.S. corporate bond market by 48 hours, miraculously, liquidity will come back into the market.
Yeah.
And so clearly they haven't read those papers.
Yeah.
And as the kids say these days, my response was, show me the receipts. Show me where taking data out of a marketplace has then led to higher transaction frequency and more volume. And you can't name it. So, even with all of that evidence, and this, Mike, for me would, and I think for the audience would be helpful, even with all of the evidence to the contrary of what they're pushing forward, even the lack of any factual evidence to back up what they are stating, that still was put forward as a recommendation. Yeah. So, what happens in these discussions around market structure with the regulators where something like that can occur, where science is just thrown out of the window and history is thrown out of the window, and a recommendation is approved based on someone's say-so?
Yeah, so I don't know how familiar we are with the Fixed Income Market Structure Advisory Committee. It's a committee that the SEC put together. The SEC's chairman, Jay Clayton, came in after I served as acting chair, and he came in and said, we have an equity market structure advisor. Why don't we have one in fixed income? And I said, great question, let's do it. And so we put together one, and Chris, to your point, for whatever reason, there's this notion that this is somehow going to have magic liquidity, whether it's folks on the sell side, folks on the buy side, the issuers have sort of bought into it. Now, a couple things about that recommendation. So they recommended that they didn't specify, but it would have to be, FINRA has to do a pilot study. But what they call a pilot study is they recommend that you do a big bang and apply it to the entire market.
But I know they're asking for a pilot study, but we've had that study. It's called the 144As,
yes,
which were never reported, and being able to compare that to the bonds that were being reported, because there are 2 tapes, and it's just, we did that for what, 5-6 years between, when transaction reporting started, and by the time 144As were reported. So I understand the idea to pilot things. I mean, there was just a recent pilot program around small cap stocks, right? But
the tick size, yeah.
Right, the tick size pilot.
Some of us knew how that was going to end, but we ended up doing it anyway.
So walk me through that. How does something go to, hey, let's test it out, even though we already have the evidence? Because I'm sure with the tick pilot study, you maybe had to almost cater to someone's curiosity around something.
Yeah.
And it takes how many years? 2 years to test something like that?
Yeah. So sort of different sort of demands. So the tick size pilot. The reason why we decided to do it, and I was very clear about this, I knew how it was based. We'd already done that experiment, going the opposite. We actually decreased the tick size, and it improved. But there were folks that were gaining the ears of people on Capitol Hill, and there was actually a bipartisan bill that was working its way through Congress that would have compelled the SEC to do a tick size pilot program, and the bill would have actually specified the research design, and the research design was terrible. It was going to be a 5-year pilot program. It was going to allow for stocks to opt in rather than be randomly controlled in this thing, and it was a terrible one. So our chair at the time, Mary Jo White, I went to her and I said, look, we need to get control of this. We're going to end up doing a tick size pilot. No matter, we already know how it's going to end, but we might as well do a good one just to end it.
How did it end?
So they showed that, well, the proponents of it thought that the reason why there was lack of liquidity in this is because there wasn't enough research coverage, and back in the day, the tick size was wide enough to subsidize the research coverage. And if you followed their argument, my joke was that the sell-side analysts from 1994 were going to magically reappear. And what they didn't understand was that the markets had evolved since then, and the liquidity providers in the market today are much different than the liquidity providers in the market 10, 20 years ago. And so what happened was you just had, now you had a clustering rather than on certain pennies or whatever, on 5 cents and 10 cents. And the question, and sort of the net effect, when I left the commission, there were sort of some preliminary results, but you had, in some cases, you had some clustering that was, normally at 5 or 6 or 7 cents, kind of went to 5, so you got an improvement, but more often it went to 10, so you had disimprovement. So there was some cross-sectional stuff in there, but it really didn't affect much, and the research coverage didn't come back was the main thing. Mm-hmm. Now on the FIMSAC one, it's really up to, that one's up to FINRA. It's a non-binding recommendation. What gives me comfort is that the chief economist at FINRA, Jonathan Sokoban, is very smart, understands research design, understands all these things. So to the extent that they feel compelled to do this, I know he's gonna structure it in a very good way. He was at the commission with me at the time. And the FIMSAC, it was not a unanimous decision to go forward with this. In fact, two of the people that I put on the committees, Kumar Venkataraman and Larry Harris, dissented and said that they should not be doing this. We know how this is going to end. Right. And Larry actually put forward an alternative proposal, which was, the concern was that, right, even though there's masking in terms of the true trade size for $1 million and above for high yield, and I think $5 million and above for investment grade, that people were still somehow being able to reverse engineer who had that, and then there was front running going on, and people were committing less capital. I see you rolling your eyes like I do on this stuff, right?
It's a front running on a trade that happened, so I'm trying to understand how you go back in time and then front run the transaction. But
right. The argue is it's like portfolio trading or whatever, and they're saying, oh, this comes from this particular market participant. We know what else they have, so we'll front run the other trade. I'm with you on this, right? So the idea is somehow if you can delay this, you would decrease the ability. What Larry's suggestion was, and I thought was fantastic, was that the market benefits unambiguously from prices being in the market, the post-trade transparency. So he said rather than, and so they thought they were saying, well, why don't we raise the limit for the masking and then decrease? He said, well, why don't we just mask the true trade size even lower? Just say, hey, this was above $100,000. Yeah. And then so you have no idea whether this was like a small institutional, large, because we just need to get the prices out there. And couldn't get much traction on that for whatever reason.
Well, I think it's because there's still a belief system out there that creating a micro network around data is a great way to trade. It is a great way to trade if you're in the micro network. But if you're not in the micro network, you end up becoming the byproduct or the casualty, which is somebody else knew where the real market was, and you found out only after the fact. Yeah. I think one of the funniest things about the idea of delaying the trace data by 48 hours is, the argument is, it would allow dealers to trade out of a position. Well, what about all of those people who were basically the suckers who find out 48 hours later that they were the ones on the other side of your hedge? I think they're going to be quite sore about the fact that they were trading away from the context of the market. But it seems that despite the evidence, there's still that view, and that's I guess the way that markets evolve is sometimes we still hear old views come into place. But now what we're seeing with the U.S. Treasury market is a sort of the information's collected, but the information is not being disseminated. Yeah. So do you think a way out is to do something similar to what Larry Harris was suggesting, which is just have a really low masking threshold in terms of size? Because as we heard in this conference, there are several solutions providers here who just getting a peek of the data that's been collected can now understand what the appropriate solution should be for the marketplace. I'm wondering what would happen if they could see it every day. So is that sort of what you would recommend around moving forward with the Treasury trade reporting, or is there a different way to do this?
Yeah, so I mean, the data is unambiguous, right? That the transparency improves liquidity in the market. In terms of transactions costs going down, the ability to see things for people to hedge, for people to mark their positions, to think about their strategies, all those certain things. Volume doesn't go down, and in some cases it actually goes up. And so, if I had my druthers, I'd say just do a big bang. But in the political reality is that there's going to be a lot of pushback to that. There's going to be a lot of concerns. And so, to your point, adding the public transparency to it is probably going to have to be phased in somehow and think about it. And the key is that's where it's important that the regulatory agencies have economists to think about these issues. And the interesting thing about the Treasury market was when we had the flash crash, right, in October 15th, I think it was, and then the question was, all right, well, who regulates this market, right? And it turned out that all the regulators kind of went like this, and we were all kind of right, because it was like Treasury writes the rules, and the SEC and the New York Fed kind of enforced the rules, but nobody was, and there was like, well, all right, let's get the consolidated tape, right? The regulatory, wait, we don't have one, right? And everybody kind of looked around, and so, and thinking of the policy responses, and this is one I was quite proud of being part of the regulatory community on this one, was rather than jumping ahead at saying, oh, we need to change this in the market structure, first, let's get the data and start understanding this. And the other thing that was very nice was that the regulators all came together and said, all right, how we can either build this from scratch, or FINRA already has an off-the-shelf solution, Trace for Treasuries. And so there was some machinations, some legal things and political things and regulatory stuff that had to get through to maneuver that path. And we worked, the SEC worked, and the CFTC and the Federal Reserve Board of Governors and the New York Fed, and Treasury was really played the coordinating role in this to get that. And the idea at the time, some of us were pushing for public transparency right away, but we realized there would be a lot of pushback to that. So we said, look, first let's get Trace to be the system to collect the data, and then we'll have that second fight later. And so now that's right for that second one.
Well, it seems that a catalyst for actually getting something done, there has to be something that goes wrong. I think the flash crash obviously was the catalyst for taking a deeper look at what exactly is happening mechanically in Treasury markets. When you were bringing up like who's responsible for regulating this market and people pointing their fingers at each other, that reminded me that a similar situation happened in 1990 after Salomon Brothers was accused and actually, was convicted in whatever the courts at that time of rigging the two-year auction, or rigging the auction in the two-year note. And the only way that people realized that they had rigged that auction was because the repo rates were showing it.
Yeah.
And so the response to that was transparency. Let's at least create a pricing screen and centralize it, and that showed up as GovPix in 1991. But the story that I've heard about that is they did that as a marketplace voluntarily because they were worried about being regulated. So I almost feel like a part of the thing that we're not talking about with transparency is it's sort of like castor oil. We know it's good for the market, but not anybody's really excited to take a spoonful of it. But that was an organic reaction to a scandal where I think the dealers and other market participants knew that the structure needed something and did something about it. Yeah. And it was sort of doing it before their father came home type of situation. And the SEC said, okay, now we're going to make this happen. Is that how it happened? Or I think at that time I was in junior high school. So, but is that how?
For the bond markets, for the original?
Yeah, for at least GovPix coming to the market, because what we have with Treasuries is lots of pre-trade transparency and no post-trade tape, which is really quite odd. Yeah. But that's because 30 years ago, somebody did something about centralizing the pricing, and it was done by the dealers.
Yeah. No, I don't think, if I remember correctly, there wasn't anything big that sort of, that made people say, oh, geez, we need to add to this. It was really a speech in September of 1998. In fact, last September was the 20th anniversary of this. It was a speech that Arthur Levitt, who was the chairman of the SEC at the time, who just pointed out, he said, look, there's people have more transparency about when they go to the grocery store and buy their fruit prices than they do on when they buy a bond. And he sort of pointed out the absurdity of it. And he said he called upon then NASD to start thinking about doing what ultimately became the Trace system. And so this was in September of 1998, and I came in the SEC in July of 2002, and it was just starting to get up and running at that point in time. and the transparency was added in 2003 to 2005. So it wasn't like anything that precipitated that. But the flip side of that is it takes a long time for those things to start happening. Right now, with the Treasury market, we had the flash crash. It was like, oh, geez, we need to do something fairly quickly, and we already had the off-the-shelf solution. So that's gotten through in a compressed time frame, at least on the regulatory side. Now we got to think about it on the public side.
Well, the last sort of statement I'll make about transparency, because there is something else that we want to talk about, but I think that the way that we look at transparency in this marketplace too often is an all or nothing, where either transparency can hurt the market or transparency can help the market. Yeah. I think transparency, if you look at markets like an ecological system, like a garden, if you will, if you dumped a gallon of water on a small seedling, that's not good for it, right? But we would never say that water is not good for the garden. So it's really the methodology that we use around putting transparency in a marketplace is a big part of getting it right.
Right.
So what are some of the methodologies that you think can be effective? Because you've mentioned sort of, slowly, gradually putting things into place.
Right.
Has that been the traditional way to do it, or is Big Bang the way to go?
Yeah, I mean, it sort of depends, right? So on the post-trade, it was, sort of people pushing back and stuff. What's interesting, though, is, right, the traditional people that pushed back on that was sort of the traditional dealers, if you think of back in the day. What we've seen recently is an evolving, like, who are the market participants, not only in the equity markets, in the bond markets, right? And so we look at where are the inventories right now, right? It was back in the day, it was, the street that held that. Now, more often than not, it's the large buy-side participants, right? And I had a lot of great conversations with folks about, is today's buy side the new sell side, right? And there's actually evidence that suggests that some of the larger mutual funds and exchange traded funds or whatever are thinking about not only, or by creating alpha, not only by longer term positions, but by being liquidity providers in the market and not just liquidity providers rather than being liquidity demanders. And so that then interacting with this growth in technology and folks getting together and buy side trying to come together and see if we can do individual trades. You've also got the other thing that's happened over time is you've got, we had something called the financial crisis and the reaction to that, where you have the Volcker rule, where now you have a lot of the banks are Volcker constrained on the amount of inventory they can hold or the positions, how long they can hold stuff. And so you have a lot of non-Volcker participants that are filling that space, and you're seeing an evolving thing in the marketplace with technology and all these other sorts of things. So me, as a regulator, the first thing I want to do is understand all these dynamics and to say, all right, is there anything we need to do to help facilitate this competition in the market? Is it better for us to stand on the sideline and just sort of watch this happen and see what's going on? Are there impediments to competition that are out there, regulatory or otherwise, that would help facilitate competition without sort of putting a thumb on the scale for one particular business model over another?
Yeah, well, anytime I hear, and we've heard it a lot, I think it's a reoccurring theme in fixed income where the buy side's thinking of becoming a liquidity provider, it does kind of bring a smile on my face because I think that things are best understood in this market using analogy. And the buy side becoming a liquidity provider, to me, is like, hey, I'm really good at throwing dinner parties, so now I'm going to start a restaurant. Hold on a second. Wait a second. If you're going to be a liquidity provider in this marketplace, as liquidity providers know, you've got to have your shelves stocked with bonds that you have on your balance sheet. You've got to be able to react spontaneously to what other people want. You've got to be able to deal when somebody says they want something off the menu.
Yeah.
So it's very, very different than when you're throwing a dinner party and you get what you get, right?
Yeah.
And so it's just that reality of what the challenges are of actually being a liquidity provider, I don't think they're quite fully appreciated. Like, if you really want that life, that's fine, but it means something totally different than what I think a lot of buy-side institutions think it means.
Yeah.
I think what they think it means is you just get to collect bid offer all day and go out to dinners. And I can tell you, having spent most of my career on the sell side, it is not that.
Yeah. Well, and the other constraint is that I'm very aware of is on the regulatory side, right? So if you think back to remember the Third Avenue distressed debt fund, the credit fund?
Yeah, that was fall of 15.
Yes. Yeah, December of 2015,
yeah.
Right? So it was, at the time, everybody thought they were more of a high yield fund, but they were more distressed debt, had highly illiquid positions in there. And I remember this was on a Friday, and people said, aha, it became revealed to the market, this is the day we have the death spiral in the high yield bond market. This is the day that everyone's going to sell, it's going to be terrible, right. You know, and it didn't happen. The following week, we had one of the large mutual fund complexes come see us about, we had a rule out for a proposal called the Mutual Fund Liquidity Risk Management Rule.
22E-4?
Yes. Okay. Very good.
I actually read this stuff, so I'm embarrassed to say.
Very good. And so in that, so the idea is that the SEC, in order to make sure that mutual funds have sufficient liquidity, there's minimum liquidity requirements for the portfolio manager, because they have daily redemptions, and so the idea is you can't have them all in illiquid assets, right? And so there's, you know, we had proposed that there were certain liquidity buckets, and you had to have minimums in the different liquidity buckets, right? And one of the things under consideration was that if you got above a certain threshold in the most illiquid bucket, that the SEC was going to force you to sell those securities, right? And it didn't seem right for me. I couldn't put my finger on it. So this Third Avenue thing comes. One of the mutual funds came to us and they said, thank goodness you guys did not have that rule in effect, because we would have been, the mutual fund would have been forced to be sellers into that market.
That's right.
Exacerbating the problem.
Yes.
They said because we had flexibility in our rules, we were able to trade off liquidity. So we were able to sell some more of our liquid stuff into the market and buy some of this distressed debt, because prices had gotten low enough, yields had gotten high enough, and benefited their shareholders, and they knew that they weren't going to have a run on their fund. And so their point was, look, if you try to force us to have these really hard liquidity requirements, you're going to actually make us create the problem you're trying to solve in it. And that was like an aha moment for me. It was like, and to your point, that they, you know, as being liquidity providers, we need to think about those issues.
Well, I'm pleased to hear that aha moment was a part of the way you were looking at it, that they came to see you. Because when we do look at recovery from crashes, or all the way going back to the crash of '62, what you see is it is the asset management community that brought the bid back into the market. Because eventually the market dislocates to the point where they say, I can't not buy.
Yeah.
Instead of other participants who are saying, I can't not sell. And so without that counter, if we put out a rule handcuffing them from actually participating and bringing the bid back, I do think it would, you know, it would create unintended consequences. Okay, so I know you and I could talk about this for a long time, but I want to get to something that is actually really important, and something that I don't notice talk about a lot when it comes to regulation in the fixed income markets. And I keep on telling my friends that I'm going to write a series of articles called "The Most Interesting Thing About FIMSAC is What They're Not Talking About at FIMSAC." But one of the most interesting things at FIMSAC that they're not talking about has to do with competition around the competitive environment around technology solutions. I think the fixed income market is in an interesting place in that there is huge appetite for innovation, and there is an abundance of technology solutions out there. But what we're seeing in terms of new solutions is that there are lots of incumbent providers in place who, obviously, for reasons, for protective reasons, aren't necessarily looking to open up their systems. And what I think that creates in the marketplace, and if you speak to people who are coming to the market with new solutions, it really is a stall on innovation, because the end user at the end of the day isn't able to interact with the best quality trading platform. The end user isn't able to use the best quality analytics providers. And so we're sort of caught in this, I would say, almost world of DOS. Like, imagine if we never got off of DOS, if Windows never showed up. Do regulators look at the competitive environment around technology? And if so, like, what can they really do? Because I know you don't want to get into the business of regulating what a business can and can't do. We'd like the free market to solve these problems, but I think there is a material issue here in terms of access to the end user. Having to go through someone who's competing with you is like opening up a restaurant and your landlord puts a hot dog stand in the middle of it. So how can we solve this?
I'm loving these analogies.
You got to do it, Mike.
These are
it's
great.
The only way that people get what we're talking about
no,
here.
It's good. Yeah, so I think a couple answers to that. So the first is to try to talk to as many people as possible, try to understand sort of the competitive dynamics of what's going on sort of in the markets, right? So if and understand that it changes over time, right? So when I was there before in the early 2000s, there really wasn't sort of the need or the idea for folks to change what was going on in the market. The dealers were there providing liquidity, and the buy side was happy with that, and kind of everything was fine, right? Now you have not, and there were a lot of technology providers, and they're just, arguably it was a better mousetrap, and maybe it was, maybe it wasn't, but there really wasn't an impetus to sort of change. And then you have the financial crisis, then you have a changeover, and now the buy side's getting, wait a second, we're providing now, we got to get smarter about this and all that sort of stuff. For me, the role was, all right, are there any sort of regulatory impediments to the competition? Who ultimately wins or loses, it's not up for me to say. And I enjoyed having meetings with folks that would come in and talk to me about all of their different business models in terms of, they had this trading system and they thought it was going to be the best one. I was like, wow, that's really cool, and then it wouldn't work out. And then another one was completely different. Well, that one's really cool, and maybe it doesn't work out, and other ones do, or whatever it is. But then also going forward on any rulemaking, the SEC and most of the other regulators have statutory requirements to look at what is the effect on competition, efficiency, and capital formation.
Yes.
And so on the competition side, oftentimes it's incumbents versus sort of disruptors, or big versus small, right? And so the idea is, and this is Dodd-Frank had this in spades, was that if you have a lot of new regulations that come in that have high fixed costs, so the idea is that no matter how big you are, it's going to cost you a lot of money, right? That disproportionately affects the smaller firms, right? Not only to the point where the big guys have an advantage over it, it actually creates barriers to entry. And so then you don't even have you get to the worst possible thing where you don't even have the innovation. So,
well, we have a working example of this, a recent example in the CFTC's regulation of the interest rate swap market. 10 years ago, if we were going to do a fixed income conference focused on rates, we would have been talking about CEFs all day long. And there would have been 30 CEFs here talking about how they have the new mousetrap for trading interest rate swaps. Today, it's a two-platform system at this moment. And if you speak to a lot of the people who are no longer providing a CEF option, it had to do exactly with what you're talking about, where the rules and in keeping with the rules was so costly that they couldn't hold out. And meanwhile, where the market has gone now, it's to the people who were there at the beginning because they had deeper pockets, not necessarily because they had better technology. So is there a way to test that from a regulatory standpoint? Like, what do you do? Is it the length of the rules? How do you know that it could be creating the opposite effect? Yeah,
so what we try to do is think about it at the proposal stage of the rule, right? So there's the agencies put out a proposal and ask for public comment. And so there has to be a robust set of questions at least. A lot of the times at the proposal stage, you have to do an economic analysis, cost-benefit analysis, and to think about these issues. But put out a robust set of questions, right? And part of that is to think through what are alternatives. So you have to put out there not only the regulatory idea that you're choosing, but what were other alternatives and what were the relative costs and benefits? What's the benchmark you're going to measure this against? And then think through that, and then ask questions. And then that's where the public has to come in and tell the regulators, no, you're creating barriers to entry in this one. Here's a better way to think about these issues. Or in some, so in some cases, it might be a completely different alternative. In other cases, it may be scaled regulatory requirements for smaller firms have a smaller set, bigger firms have a bigger set. In other cases, if it's going to be sort of compliance on the back end of this stuff, compliance costs will be very high at the beginning, and sort of over time, people figure it out. So maybe you have phased-in compliance for the smaller firms. They get 2 years instead of 1 year, or 3 instead of 2, or something like that. So there's all different ways to think about that. And then the other is to think about building in sort of what data do you want to, what metrics or objectives are you going to use 3 to 5 years out to measure the success or failure of this, and then build that into the rule so that you can actually do that study 3 or 5 years out to figure out, did it have the intended consequences, did it not have the intended consequences?
Well, I think when we see like massive concentration of activity, especially from an electronic trading standpoint, on a single platform, that should always raise a red flag. Not that I'm against somebody dominating, but what we know is that Murphy's Law, something will go wrong eventually. Now, in the equity markets where we have redundant liquidity pools, one of those pools going down doesn't stop the market. But when we start to see this massive concentration, and I would say that this is massive concentration not just on an electronic trading platform standpoint, this is massive concentration on a liquidity provision standpoint. We don't have a lot of liquidity in some of these markets as a claim. Well, that may also be because some of these markets have gotten more and more concentrated over time in terms of the liquidity providers that are dominating. And is that a part of the conversation at the SEC? Because it seems that old school SEC, and I actually wrote down that speech because I am going to read it, that 1998 speech. But if you read the older speeches, it's really, really focused on making sure that anti-competitive practices are not in place in the marketplace, and that rules don't foster or give rise to anti-competitive practice. Is that still the SEC's sort of thinking on things, or have they taken, or are they shifting a little bit in terms of what they see themselves as in the marketplace?
No, I would say both at the staff level and the commissioner level, taking the statutory mandate very, very seriously to take into account the competition, efficiency, capital formation. One, because it's the right thing to do, but two, because folks have gotten more bold over the last 20 years about judicial review, right? So there is a right of recourse with the government, is if you think the SEC did not fulfill its statutory mandate in terms of either the content of the rule or the process by which they went through, not doing cost-benefit analysis or any of the regulators, you can take them to court and do that. Now, obviously, individual firms, it's costly to do that, and you kind of win the battle, lose the war with the regulators. So oftentimes it's done through trade associations or Chamber of Commerce,
who can I call at the SEC
or those sorts of things. And when we have seen it, we saw in the early 2000s. So the SEC did not take its cost-benefit analysis very, very seriously up until they lost a number of cases in court, and then all of a sudden, it's amazing what happens. And we put in economic guidance. It's up on the website the SEC has out there, where it shows like this is the process by which they have to go through on this. And the idea is, it's like, look, we might as well get it right on the front end rather than get sued and have to undo it on the back end and try to minimize.
I did not know that somebody's watching the watchman effectively.
Yeah. No. There's a number of different cases where that happened, and so it was very. So when I was there as an economist working on the bond market research stuff, it used to be that the last thing you wanted to do as an economist at the SEC was cost-benefit analysis, because nobody took it seriously. Now, all of a sudden, after the court cases and the flurry of rules that went through during Dodd-Frank, it's actually one of the more exciting, one of the more sort of intellectually stimulating things to actually think through a lot of these things and think about, like I said, building it on the front end. What's the data we need to get? What are our measures of success? And then you can sort of build out 3 to 5 years and then go out and see whether or not they had the intended effects or not. So.
Well, we are a little bit over time, and I don't want to hog you for the entire session. I'm sure there are at least 1 or 2 questions out here for Mike. Does anybody have a question for the panel? We can hear you.
On the CAT program, is there any well, maybe just quickly get your view on that. And then also, too, is there any idea of moving that to the fixed income market eventually? I'm sure it'll be way in the future.
The consolidated audit trail? Yeah, I mean, it's a different animal, right? So Trace basically captures all the over-the-counter stuff in the corporate bond market, and then there's basically everything sort of has to get reported there, right? So the consolidated audit trail, I just rolled my eyes on that one in the equity market, right? So to your point, that was one where we had the flash crash of 2010, and it happened in the equity markets, the futures market, right? And the CFTC just downloads the data from the CME, and they're done. Whereas the SEC, it took them months and months to get all the data together. So the idea was, let's have a consolidated audit trail, right? And so they started this before I became a commissioner in 2013. And what they did was they ran it through what's called an NMS plan, which is basically the SROs, all the exchanges have to get together. So the SEC ordered the exchanges to go out and come up with a plan for the consolidated audit trail to come back that the SEC approved and go through that. I have come to hate NMS plans, because what happens is the commission loses control over the process, and that's what the SEC had been struggling with. The commission was losing control over this process, and there was who's going to, the governance of it, that took a while to get up and running, then who the CAP provider is going to be, and then there's fighting between the CAP provider and the SROs, among the SROs, And I can't tell you how many meetings I would have where one of the exchanges would come in and complain about the other ones, and then the next one would come in and complain about the other ones, and the next one. And then you get the SIFMA folks and the buy-side folks who say, we're not even in the room, and we actually are the ones who, this matters for us or whatever. And it was a complete disaster. The tick size pilot was also an NMS plan. We lost control over that, and the exchanges did that. And so then we also did the access fee pilot, which is going on right now. And that was one where Commissioner Stein and I both said, we're going to do this as a real rulemaking. We're going to continue to have a role in this rather than having it as an NMS plan. So the consolidated audit trail is a good sort of, in theory, a lot of the sticking points right now have to be sort of on the operational side. And then the privacy issues in terms of the customer data that's in there, how much of that gets centralized, and to make sure that the publicly, or PII, the personally identifiable information in that. So, and I see that as, still it's going to be years away, unfortunately.
It was nice in theory, but in practicality, it's so complicated.
It's very, very complicated. Yeah, I'm glad I don't have to deal with it anymore.
The interesting idea, since the fixed income market is more electronic and there's algorithms starting to play, but no, way in the future.
Yeah.
Take one last one, if someone's got a good one. Yes?
How much work can the SEC get done right now on the rule writing, on
Yeah.
as long as the government shut down?
Yeah. So for those in the back didn't hear, we want to know about what the SEC is doing in terms of rule writing and that sort of stuff, right? So the SEC is an odd, so there's different agencies that are affected by it, right? So some are not, right? So among all the financial regulators, right? So the bank regulators are funded by fees. They're fine. CFTC has to shut down because they get appropriations. The SEC is an odd duck, where the SEC gets, the appropriation level gets set by Congress, but then we collect fees in order to hit that level. So in October of 2013, there was a shutdown, and the SEC was able to remain open for a little while. And the reason why was just simply a cash flow timing issue, where the fees had just come in, there was a bunch of fees in the account, and they could continue to pay people and pay the vendors and keep the lights on, all that sort of stuff. If that shutdown had continued, we were looking at this every single day, 3, 4, maybe 5 more days, the SEC would have had to shut down. This shutdown, the SEC had to shut down right away. It was just a matter of the timing of the fees, right? Except for, and they have a plan. That the plan is actually on the website in accordance with the OMB circular. All the agencies have this stuff that's out there. And there's basically exceptions for law enforcement. It's protection of property, protection of life, all that sort of stuff. And so the SEC takes the view, and OMB has gone along with this, that sort of a skeleton crew of particularly enforcement folks that are there to do things like, if we find money obtained by securities fraud is in a particular bank account, we need folks to be able to do the go in front of a judge and get the temporary asset freeze and do that sort of stuff. We need folks to be able to go into court and file with the criminal authorities when they arrest somebody, and we're working with them on that. Short of that, there's not much else going on at the SEC, because it's literally sort of skeleton crew. And my understanding is, right, so even at the commissioner level, commissioners have 4 counsels and an assistant, so 5. But under this sort of the shutdown, sort of the break the glass thing, they're allowed to have 1 full-time equivalent. And so my plan, and my understanding is that most of the commissioners end up doing this, the same plan is that you sort of designate 1 person each day of the week. So you have a rolling, that sort of person. But there's really nothing that can be done in rulemaking. There's even the folks that review filings in the corporation finance and investment management for things like IPOs, for other types of activities, approval of products, no action letters. Think of in the investment management side, all exchange traded funds are done by sort of no action relief, exemptive relief, all those sorts of things are just sitting there in the meantime. And so there's been actually some things written in the Wall Street Journal about this, sort of thinking about some IPOs and some other types of corporate events. So.
Yeah, those SEC folks are also not allowed to go to conferences in New York during the shutdown, is something that we found out.
No, there's a big conference. The SEC Speaks in February is a big conference they do in conjunction with the Practicing Law Institute, where it's a huge thing. And so that one's, it's a big deal. There was, Commissioner Peirce and CFTC Commissioner Brian Quintenz were supposed to do an event in D.C., the Bipartisan Policy Center, on Monday I was going to go to, and they had to cancel that. So,
wow.
it's not a lot going on, unfortunately.
So we're actually thrilled that you got out and that
Yeah,
you were able to
I am
come-
too.
that you come here.
Yeah.
And just your contribution to making fixed income markets better functioning and innovative is it can't be understated. And we really, really appreciate you making time for us here. Thanks so much, Mike.
Great. All right. Thank you, Chris. Thank you all.
Yeah, sure, of course. Guy, that was awesome.